Okay, all right. Thanks very much, everyone. So yeah, I'm going to talk to all things China for the next half hour or so. So in terms of Shanghai metal market, so yeah, I've kind of been a commodity analyst for 17 years. Was at Rio Tinto, then on the sell side for the last 7 years. Switched to Shanghai metal market end of last year. So SMM's probably the leading independent information provider in the Chinese metals market. So do a lot of consulting projects for all the big miners, deep dive studies on where's the Chinese domestic iron ore cost curves and where's the new capacity coming on, where's all the policy changes, the kind of outlook for scrap, graphite electrodes, all of that kind of stuff. So very big in the base metal space, ferrous space, and new energy, of course. Everyone in China uses our prices for their lithium and cobalt contracts. So yeah, that's our core focus. So in terms of where we are today, the demand's actually doing pretty well in China right now. So we started the year quite cautiously, that Beijing was clearly messaging they were going to have quite a slowdown this year. Macro-wise, China is always counter to the world. Global economy is weak, that's when they stimulate. Global economy is strong, that's when they slow things down. And that's what we were looking at the start of the year. So there's a very clear message out of Beijing. They're going to slow infrastructure spending and going to have a credit tightening cycle. Now that's exactly what we saw in March. Demand, we came out of Chinese New Year, credit was very tight, and that's why you saw quite a sell-off for things, especially like steel. Now, since mid-April, that's really gone into reverse. The worries about the potential trade war, the fact that global growth indicators have kind of rolled over, Beijing is now essentially slowing the slowdown. They've really stepped back from that tightening angle. So yeah, credit tightening has been the most notable change that we see. If you look on the credit there, so March new lending was pretty weak, and then April came in very strongly. Shibor, you can see there, since April came off a fair bit. We had a triple R cut. So credit conditions have clearly improved over the last couple of months versus where we were in the first quarter. Now, obviously, one of the big drivers for commodities, it's all about housing and infrastructure in China. So like we said, start of the year, Beijing was very much messaging about slowing down the infrastructure side of things. So we've seen certainly Q1 spending, rail, grid spending down very sharply. But again, we do expect that to recover, especially into the second half. They're clearly backing off that tightness. And then housing sales, that's obviously a major policy point. Now, the housing market's really undergoing a lot of fundamental changes in China right now. This is core of Xi's social policy angle. The one thing he said in the Congress last year, housing is for living, not for investment. So a lot of people thought, oh dear, that means they're going to clamp down on private housing again. Not the case. What they're doing is essentially saying, look, affordability ratios everywhere in the world are very problematic. I can't bring prices down. Ownership rates are too high. So I'm going to follow the Singapore development model and have a two-tier housing market. So we will have an overvalued, high-priced private market, and for people who can't afford that, I will build them myself and give them away cheaply. So last year, the central government spent 1.8 trillion RMB buying 6 million apartments and just giving them away last year. Equally, a third of all new housing development this year in Beijing and Shanghai is going to be rental housing, where the government will build it cheaply and rent it at cost, so that young people, people in their 20s and stuff, can still urbanize. You can still move from the countryside into the big city, live your dreams, have somewhere cheap to live. So that's a core angle of social stability. From a steel and cement perspective, it's a great underwriter for the demand, because yes, the private market pressure remains on, things remain intense, but from the government is increasingly getting involved in the property market, and more you're going to see that being driven by government spending. So debatable how big they can keep this, for how long. It's very expensive to do. But fundamentally, government is very much going to be pushing the housing construction more than we should expect structurally. Structurally, China has horrible demographics. Right? We've already got a massive overbuild on property. If you look at the registered urban residents, the ownership ratio is about 1.2 units for every one family. Right? Fundamentally, they could stop building apartments tomorrow. They've got enough of them, but those people are selfishly sitting on them, whereas the people who want to find somewhere, they're not rented out, so the government's got to build that alternative themselves. So it means we will get a structural overbuild, great for steel and cement demand. But yeah, so fundamentally, less negative on the housing market than we would have been a couple of years ago, because Xi is clearly voicing his support and the fact that they're going to provide those facilities for the people. So obviously commodity land, two big issues that big influences on commodity prices tend to be the dollar and oil. Now, last couple of months, these have really been pulling in opposite directions, right? We've seen strong oil prices, but we've also seen a strengthening dollar, which is a very unusual situation. So I think that metal prices have actually done pretty well given the dollar strength. That's one of the big risks I was warning of at the start of the year. Q4 last year, we saw a lot of money flooding into the commodity space. Prices of everything, especially things like copper, were doing very well into the new year on this structurally bearish 5-year dollar view. Now, last month or so, dollars rebounded quite sharply, quite unexpectedly, but the metal prices haven't really sold off. That's been quite impressive that they've held up. So I do worry as a short-term risk. If we see more strength in the US dollar, that could be a real headwind. Certainly, a lot of the commodity trading now is driven by the algorithmic trades, and if they see dollar going up and they see inventory going up, they could turn very aggressive sellers. So I think there's a short-term risk if we see more dollar strength, but if that rally in the dollar is finished, then again, that should be very constructive for the metals. So we start off on aluminium, or aluminum as you like to say here. It's obviously been a very, very political one recently. So the story on aluminium in China, though, is, we have this misconception, supply side reforms. That's something which everyone throws around in China. That's what they're doing everywhere. Supply side reform is very different in each industry. Steel is the only real supply side reform that we've seen. I'll come on to that later. Coal was not really supply side reform. That was a bailout of the financial system, because the steel and aluminium plants are generally levered up with SOE bank loans and not an imminent systemic risk. Coal mines were levered up with wealth management products, private investments, and bonds. So January 16, the Ministry of Finance was saying we are looking at a horrible default schedule for all these private coal mines. It'd be much easier if the government just got the coal price up. So that's what they did. It wasn't really supply side reform. Supply side reform is closing the small ones to make the bigger ones stronger. In coal, they told the big guys to cut production to keep the small guys in business, because the rate that the small guys were going bust was causing too much pain. So coal wasn't really supply side reform either. That was a financial bailout. And aluminium is not supply side reform. Aluminium is all politics that revolves around Chalco. So Chalco is supposed to be China's flagship commodity company, right? Dominated in aluminium. And last 3 years, it's been a disaster, right? They keep suffering from that competition from the new private guys, especially Hongqiao, Xinfa in Shandong, adding lots of low-cost capacity. Chalco was forced to cut. So Chalco had a horrible balance sheet at the end of 2015. It was in a very bad way. So whereas Chalco has a lot of political power, so they've managed to engineer this under the supply side reform banner. Essentially, let's kill off the private guys and repair Chalco's balance sheet and make them much stronger. So that all concluded, though, last November. So if you remember last year, Hongqiao was kind of persona non grata. They were suspended for much of last year. But in November, CITIC, the big Beijing conglomerate, took 17% of Hongqiao. Immediately after that, they got a big discount to the winter cuts. So the winter cuts never really happened. Initially, people were expecting up to 2.5 million tons of aluminium to be shut during winter. It ended up only being a million tons. And because we still lost a lot of demand over winter, that was underestimated. Everyone's doing their equations. Okay, if we close these smelters, 30% here, 30% there, we lose X supply. The issue is we lost an awful lot of demand. Right? There was a blanket ban on construction for 4 months across northern China. So that hurt demand more than it did supply, and that's why we ended up out of winter with record aluminium inventory. So yeah, aluminium horribly oversupplied right now, and the Chinese onshore market is pretty depressed because they see, look, Hongqiao has been bailed out. We've finished this, essentially the cut story, and there's still 9 million tons of new smelters in China under construction at the moment, 4 million ready to go this year. So the Shanghai price has done a very good job of stopping them from starting up. So onshore aluminium prices have been pretty weak, pushing against the cost curve. So that's why we lost 1 million tons of smelters over winter. Only 500,000 has switched on so far. Now, like I said, also this year we've got 4 million tons of new smelters planned to come through. Equally, 1.2 million of that's ready to go. But again, they're not ramping up. They're sitting there saying there is no margin, so I'm not going to start production. I'm going to wait and see. So we are slowly digesting all that aluminium inventory that we built, but there is an awful lot of capacity overhang in aluminium that's still there. So fundamentally, aluminium, people have got the wrong end of the stick on supply side reform. The top-down view is China's not going to build new smelters, so prices need to be high so the rest of the world can produce more aluminium. Well, that might be the story in 2020, 2021, once we've digested all of these, but these smelters are still happening. And because the whole thing is about bailing out Chalco, in steel, it's a very strict replacement policy. If you want to build a new steel mill today, you have to demolish an old one. Whereas in aluminium, this capacity started production, some of it illegally, but as long as you compensate Chalco, you can basically buy Chalco's license for something that they closed in 2013. So this is not really replacement capacity, it is new capacity. It's just from a paperwork perspective, shuffling around some licenses. So onshore aluminium in China still looks horribly oversupplied. We can't get excited about that for the next couple of years. And then the big story, so it's obviously going to be cost-driven. Anodes, thermal coal have been a bit weaker out of winter. Thermal coal prices, they were high through last year essentially because of the weakness of hydro. Hydro underperformed so badly in China last year that added 100 million tons of thermal coal demand. So Beijing's been trying to push coal prices down. They cancelled the Chinese New Year holiday for a lot of mines this year. That added alone 50 million tons of supply just for working through the holidays. And we think supply will grow 150 million tons this year. But right now, coal still looks quite tight because demand is good and hydro is still down year on year. So overall we think coal market's still going to remain reasonably elevated. And then alumina is the big question mark at the moment. Obviously, we've seen a lot of drama in alumina globally. Right now, China has become an alumina exporter because China has no shortage of alumina. So like I said before, we lost 1 million tons of Ali smelters. 500,000 of that has switched back on. We lost 4.5 million of alumina refineries. All of that is back operating now because the profitability is very attractive. So China has exported about 400,000 tons of alumina so far with the higher price. So the key question for alumina and as a cost driver for aluminium is what's going to happen with Alunorte in Brazil. Right? If that can come back on before China goes into winter again and has more cuts, similar volume to last year, then alumina will be pretty sufficiently supplied. Prices can be stuck in the $300 level. If Alunorte is not able to get back in before China then goes into winter cuts again, then alumina could be stuck at $500 in Q4. So there's a real race for time there whether Alunorte is going to get back into an operable capacity before China starts closing stuff again over winter. Because winter cuts will happen. Environmentalism, phenomenally successful. Last year, the winter cuts, the air was much cleaner. So there will be more cuts this year, maybe slightly less of a degree. But certainly for alumina it will happen because it's massively beneficiary to Chalco. Having a high alumina price helps Chalco because they're long alumina and they sell it to the other producers. So alumina we'd favour over aluminium. Fundamentally though, no shortage of supply of either for now. If we move on to copper, copper, it's a kind of a tale of two markets at the moment. You look at copper from the concentrates market, it looks very tight. China's adding 1.1 million tons of new smelters this year. And people are expecting a lot of mine disruption this year. It's just not happened, right? So mine disruption's much less, but still the TCs are extremely tight. There's just a lack of cons available. So they've been going up the last couple of weeks with the Vedanta closure, but fundamentally, TC market still looks tight. Whereas we look at the refined copper market, it doesn't look so tight. The inventory levels are pretty reasonable. Physical premiums are not that high. So overall, copper looks like a fairly balanced market today. But that's been with a very weak backdrop, right? Because grid spending, first 4 months of the year, grid spending is about 40% of copper demand in China. And that was down 24% year on year through the first 4 months because Beijing was trying to slow things down. Now, we're expecting an imminent acceleration in that. All the wire and cable guys we speak to say they're expecting grid orders to come through very soon. So copper will improve through the second half. So right now, on a 1 to 2 month view, I'm a bit nervous about copper. I think that Given the strength in the dollar, it's held up very well. Given the high inventories, it's held up very well. So you could see a breakout to the downside in copper prices if either of those things continue. But equally, structurally, it is going to tighten up in the second half. Demand's still doing well and will improve. And copper is fundamentally the best of all the commodities, right? Just geologically, we've used all of the good stuff. New mines are lower grade, deeper underground, difficult operating environments. So new supplies at the top of the cost curve, not the bottom. And the new projects take 5 to 8 years, and we haven't been signing off enough of them. So we've got a lot of long lead time. I'd also say copper is my favorite way to play the EV story, because we may not know what battery is going to win, but we know that they'll need an awful lot of wires. Right? EVs generally have 80 kilograms of copper wiring instead of 20 in a regular sedan, and we have to build out all the charging infrastructure as well. So copper already has a great story. Supply is going backwards from 2019. I think Codelco has to spend $20+ billion just to maintain production, because 4 of their top 10 mines are over 100 years old. They're running out and deteriorating so rapidly. And on the demand side, copper is a consumer leveraged product. It's not just China demand, it's the global emerging middle classes, people in Southeast Asia, India, elsewhere, buying electronics, air conditioners, appliances. That's going to use more copper, so it is a structurally very solid outlook for copper. Scrap as well, that's something that's been a bit controversial, obviously. China kind of saying, right, we're more developed now, we don't want to import low-grade scrap and process the dirty stuff. But people expecting China's scrap imports to be down heavily, I think you'd be a bit disappointed, because basically the stuff is just shuffling around. Right? So China is saying we're not going to process the low-end copper scrap, but that is happening elsewhere. It's just diverting to Vietnam, Cambodia, and other countries as well. Hong Kong, Singapore also building very high-end scrap processing facilities as well. So the scrap is just reshuffling around, and at these prices there's a big incentive to get it into China. So we think the idea that scrap tightness will really hit copper is a bit overdone. It doesn't take long for it to shuffle around. I'm interested of time, I'll just keep skipping forward. The slides are available. If you just ask the organisers, they can send them through to you. So zinc's an interesting one. So if we go back to the start of the year before those big inventory deliveries, the story on zinc, well flagged. Everyone knows there's 1 million tons plus of new zinc concentrates coming in the next 2 years, but it's back half weighted. And at the start of the year, we're drawing that inventory so quickly. So the question mark over zinc was, are we going to run out of refined zinc before the new mines switch on? Now, it turns out that there was a lot of hidden inventory playing that trade. So once the price went up to $3,400, they said, right, that's enough, I've made enough profit now. And they delivered it all in one go. So you saw 77,000 tons into New Orleans. A few weeks later, we saw another 30,000 tons into Antwerp. In China as well, there's been about 300,000 tons of refined zinc in bonded warehouses that started coming into the market. So LME week in Hong Kong a couple of weeks ago, no one was talking about zinc. Zinc's like, that's finished. It's last year's story. It's completely off the radar. So that makes me quite optimistic that zinc may get a last pop higher before that new supply comes on, because essentially we've now flushed out all of this hidden inventory, but demand is still doing quite well. Autos are better than expected, and we're still starting to draw the inventory again, even though we're now from a much higher level. But new mine supply never exceeds to the upside. It only ever disappoints. So if we get a bit of disappointment on the new mine supply and we're drawing the inventory and we no longer have any hidden inventory that can surprise, then maybe zinc can tighten up again, and it could do pretty well through the kind of second half before the new mine supply really comes online heavily next year. So, and then equally, all that new mine supply that's coming through, we need that just to balance the market. Zinc has been in such a big deficit last 2 years. This new mine supply is just going to balance the market. It's not like aluminium or nickel where we have an abundance of those units. This new zinc supply is just going to be balancing things. It's not going to send us into mass oversupply. So the kind of downside in zinc near term is pretty limited as well. Now, if we move on to nickel, that's my most controversial one, because I know you can't really insult nickel today. It's the golden child of the commodity world. But I have to say I'm not very excited by it. I think it's massively overplayed as a story. Right, last 8 years, the marginal nickel price has been set by MPI in China. Right, 3/4 of nickel still goes into stainless steel. Battery consumption of nickel is about 60,000 tons, 3% of the nickel market. Since an LME week last year, last November, nickel prices have just ripped higher, massively disconnected. The marginal cost of NPI in China is about $11,000 a ton. In Indonesia is about $7,000 to $8,000 a ton. So the profit margins in NPI are massive right now, 30-40% margins. Equally, stainless mills in China are losing money. So that doesn't look like something that can last for very long. So we are starting to see nickel pig iron production respond to these huge margins. Now we've had the environmentalism over winter held us back. We've now got another round of inspections that's been hurting in the last few weeks. But April NPI production was up 33% year on year. Right? The Indonesian ore as well is starting to arrive. We're seeing the port inventory rising up. The nickel ore prices are a bit lower than that now. So the nickel ore is moving in. And also Indonesia as well. So overall we've got huge growth in NPI output in both China and in Indonesia this year. Total of 155,000 tons of nickel units. Like I said, the entire battery consumption for nickel is 60,000 tons. So everyone's like, yeah, that's an interesting story, but it's the wrong kind of nickel. But the issue is that there is a feedback loop, right? Stainless mills in China, if they're using this abundance of NPI, then that's a structural cost advantage over stainless mills using refined nickel. So you're just going to see greater stainless export pressure out of Indonesia and China, and you're going to see steel mills there switching to more NPI, less refined nickel. So the key data to watch really is China's imports of refined nickel, that as they use more NPI, refined nickel imports should decline, and that will then allow more nickel to go into the LME. So China this week, we've had a bit of a short squeeze. There's only about 28,000 tons of nickel inventory in SHFE warehouses and about 100+ thousand ton short position. So that's why nickel was on a bit of a tear last week. But we're getting through that. And fundamentally, the one thing that keeps the bulls going is that every week LME prints a lower inventory number on nickel. Now, what have we seen in the last 2 years? We've seen games played in zinc, where we suddenly had the flood of off-exchange inventory delivered, and that killed the price. We've seen in copper the last couple of years. The big traders know that the algos are programmed to sell if they see a big delivery, so they just back it all up in the warehouse and put it all on in one day. So for nickel, the one thing keeping the story really going today is that every week LME publishes a lower inventory number. So could somebody be taking it off exchange every week just to make sure that keeps happening? And then once they see the NPI numbers really ripping, they'll deliver it all in one go, and that'll burst the bubble. The conspiracy theorist in me says that that's probably going on. No evidence to say that it is. But certainly we've seen that in zinc, we've seen that in copper. It would be very logical for somebody to be doing that in nickel as well. So yeah, I get the whole nickel in batteries story is great in the 2020s. It's just that right now, the battery consumption of nickel is so small, and the stainless still dominates, and NPI still dominates as a stainless input cost, and there is a feedback loop. We cannot see this nickel price and NPI margins staying so high for so long. So yeah, nickel's something that not so keen on at all. And then if I just round off on some of the other EVs, so lithium, the big issue for lithium last year was the lack of processing capacity. Right? China's built loads of battery plants, but there's plenty of spodumene, but there's no processing capacity. That was the barrier last year. Through the second half, the processing capacity has been switching on rapidly. So that's why we've now seen a bit of softness in the lithium carbonate, lithium hydroxide, because the processing is happening now. So we are seeing certainly like all the DSO ore that wasn't being processed last year is now being processed because the capacity is switched on through the chain. So there is a fair bit more lithium around now. We've alleviated some of those processing bottlenecks. That's meant the price is a little bit weaker. So certainly demand growth is going to be good, but right now supply looks quite sufficient. There's still new mines switching on. China's kind of building the processing capacity. So I think lithium looks like it could stay under a bit of pressure in the near term. Cobalt's obviously much stronger, still more worries about where they can get the supply from, but equally there's a lot of hidden cobalt inventory in China. We reckon about 30+ thousand tons of cobalt in China. If we get more news flow out of the Congo, making things look more certain there, if we start to see a bit of supply growth coming and those guys take profits, similar story to zinc, then you could see cobalt coming under pressure. But structurally, it's still got the best supply demand out of all the kind of battery materials. And if we just finish off on the ferrous space, So steel is probably my favorite place on a short-term view. That, the issue in commodity world at the moment, base metals have been massively influenced this year by global macro, right? The whole dollar, global growth, Trump, trade, all that kind of stuff's just been hitting base metals all over the place. Steel is really a pure onshore China story for steel and iron ore. So yeah, demand was weak coming out of Chinese New Year. Credit was very tight, but actually steel today looks very, very strong. So our steel PMI in April was the strongest since October 2016, excluding that Chinese New Year there. And the draw on steel inventory has been the fastest pace that we've ever seen. And normally, by now, steel inventory starts to plateau, but it's still drawing. So I think give it a few more weeks, steel inventory could reach critical levels, and you'll start to see steel prices in China really taking off. Because there's just no surplus steel capacity anymore. The supply side reform means we have closed so much steel capacity that things are running flat out. So demand is doing well, prices can continue going up, margins can be sustained. And then going forward, China is doing this massive switch to EAFs. So they're building out a lot of new steel capacity, very much on a replacement. So you have to replace the stuff in the lower table is the stuff that's getting switched off. The stuff in the upper table is the new capacity. So the EAF installation people, their order books are 2+ years. You can't order a new EAF today for delivery in less than 2 years because there's so many of them being built right now. So China's having this massive upgrading of the steel industry, massive switch toward EAF because they see the scrap coming. China's consumed 10 billion tons of steel in the last 20 years. Last year they got 80 million tons of obsolete scrap from that 10 billion ton scrap pool. So the scrap generation is starting to take off now. If you look at Japan, Korea, Taiwan, they started to get 25 to 33% of the steel came back as scrap with a 15-year time lag to consumption. So China was a 100 million ton a year steel consumer in 2000, went up to 650 million tons by the end of the decade. So that S-curve in steel consumption in the 2000s is now starting to be replicated as an S-curve in scrap generation. So that's why China is building all these EAFs. Every developed economy in the world gets 40, 50, 60% of their steel from scrap. China still gets less than 20 today. But fast forward 10, 15 years, they'll be similar to the rest of the world. So that's obviously a massive structural negative for the iron ore story. But from a steel perspective, environmentally, EAFs are just much cleaner. I don't have coke ovens and I don't have sintering plants, and that's the focus, keep the emissions down. So that's why Beijing's really aggressively building these out. And then short term, I think iron ore, if steel keeps doing well, if this inventory draws and steel prices go up a bit higher, where's the iron ore charts gone? Sorry, it's not in there. Then I think iron ore can catch a bit of a bid as well, because fundamentally we've lost a lot of iron ore supply this year. Minas Rio, IOC, BHP downgraded their guidance, and the low cost, the low grade, low price ore has been switching off. We've lost Atlas, Cliffs in Australia, West African stuff, Indian stuff. So iron ore supply today is down year on year. Steel demand is doing well. Steel prices and margins are very strong. So I'd say iron ore has certainly lagged the rally, but if steel runs much further, I think iron ore can put on $10, $15 on a 3-month view. But structurally, with all this growth of scrap in China, then that's going to kill iron ore on a structural basis. So I'll leave it there. I think we've got a couple of minutes for questions, if any questions in the audience.
What's your view on iron ore domestic production? And there's been a lot of speculation about the amount of production that actually happens within China and what the delta is between that and what needs to come from onshore. And so what do you think that delta is? And where do you see that progressing?
Sure, the key thing is you can't use any of the MBS data, right? MBS doesn't know what's going on in China. That's why you need to use kind of all of our data stuff. That's why I've joined these guys, because they have the best data that there is. So steel production peaked in 2013 at 904 million tons. And that year, domestic iron ore consumption was 440 million tons. All right? Now, last year, steel production was about 858 million tons. And iron ore consumption was 258 million tons iron ore production in China. So we've already closed 200 million tons of mines. Now, there's over 2,000 iron ore mines in China that we know about. Only about 350 of them are operating today. And current run rates are about 200 million tons. Now, of that, about a third of that comes from underground. Now, at the moment, you've got this clampdown on open pit mining in China, because it just causes too much dust, right? They're mining very low grade ROM that they have to concentrate, and it's just causes too much dust and pollution for Beijing's liking. So places like Hebei, we have a blanket ban on open pit mining. So 40 million tons of those mines are actually investing to go underground. So instead of getting a 15% ROM, you get a 35% ROM underground, and you only need kind of 2 tons of that to concentrate instead of 4, 5, 6 tons of ROM from the open pit mine. So the actual operating cost is not substantially higher, but there's a big capex cost to make that switch. So yeah, domestic ore has already fallen from 440 down to about 250. I think this year it'll be about 200, and structurally it'll be sustainable at about 150. So we think about 180 million tons of domestic ore is owned by SOEs and steel mills, but even that will have some economic rationality to it. So some of it will close as iron ore gets kind of cheaper and cheaper. Long run, I think iron ore should settle around $50 a ton, because yeah, we think scrap goes from 180 million tons currently, 80 obsolete, 100 prompt scrap, to 300 million tons. So, yeah. So we've got 120 million tons growth in scrap by 2025, 100 million ton decline in steel consumption. So that will cannibalize about 300 million tons of iron ore demand over the next 8 years. Yeah.
Could you carve out the rebar part of the steel markets separate out? What is your view on that?
So rebar looks pretty good because the construction stuff's looking quite good. Right? So rebar's obviously the one which tightened up most with the induction furnace closures, because a lot of it was kind of very low grade. And people have been very pessimistic on it because there was high inventory and the government was saying they're going to slow things down. But now clearly the inventory has been coming off and the demand's good. Properties still are positive. So yeah, the outlook's good. I mean, hot rolled coil prices in China have been pretty flat all the time. Rebar's the volatile one. But no, that's where we think you'll see most of the strength on the short-term view. Yeah.
Are you ready to put uranium into your analysis?
So we don't cover energy, but I know a lot of people are getting more excited about the uranium space. That you've seen kind of so much cut to supply now, and the demand's there, and it's certainly been such a massive laggard. It's got to have its day eventually, but it's not something I look at myself.
Okay. Thank you very much. Let's have a round of applause for Ian, please.